once you get off of below the, so we'll assume in here the 12 region banks, and then off of the region banks are going to come each money center bank that happens to exist in its region. Now with those special borrowing and access privileges to the Fed, they get to do a lot of things. And where it's really going to get hairy is when we talk about all the things they can do now between term lending facilities and credit debt swaps and TALFs and TSLFs, and I mean it's getting mind-boggling. And as everybody noted, we added another one today. You know, it's the plan of the. In engineering, we used to call this when things really got in panic mode. My partner and I, we always called them 5-minute design increments. When you get down to 5-minute design increments on any large-scale system, you know you're in big trouble. Okay, when the requirements are changing and you're designing new pieces virtually on the fly, your 5-minute design increments is a very bad thing. Things are really out of control at that point. Well, we're into 5-minute design increments from the Fed right now, and the Treasury. So anywhere from money center banks, basically you have the rest of the banking system from the big banks in that region. They then have, and the little guys can take some advantage of this, but they're kind of limited because they're not big guys. They're little guys. And I worked on a lot of those too, the way down the scale, the sovereign banks, the Pueblo Bank and Trust, the Keystone Bank, ones that are further down the Key Bank, ones that are further down the food chain. Second and third tier banks. Second and third tier banks exist below the money center banks in each region. They're the banks most people know that everybody deals with every day. Again, each one has the exchanger architecture within its area of operation that it uses for its credit card networks, its ATM networks, its banking, loan, you name it, their mortgage networks. Everything they do works on the same basic system architecture, and they all intertie back up from the bottom, right, and cross tie among them within the regions based on their business relationships. However they operate together within their region. Okay, are there any questions here?
You say operate together. It's got an illegal flavor to it. What do you mean there?
When they have reason, it's not an illegal thing. It's when they have reason. Except, for example, there's various electronic networks that tie the banks together. When they process loans, when they process checking accounts, when they processing of credit checks, there's all these support networks that exist, and some of them might exist through certain banks, or some banks in an area might own certain businesses as subunits of the bank. So you're in effect establishing a business relationship with another bank. So in any case, you have, like I said, this is a very, very simplified view of what is an enormous, complex system of financial networks, banking networks, credit card networks, all the things that go together. Now, what are all these things that they get to do? Well, and one of the goals I had today was to try and explain to people, like with today's event. How many people heard about what the Fed did today? Right. Well, we're not sure yet because they haven't fully explained it. Yeah, we're not really sure because they haven't fully explained yet, like they didn't do most of these things, what they really did today. The announcement is they're going to set up basically another $1.3 trillion of additional funding that they're going to provide through various mechanisms. Okay, how do they provide funding mechanisms today? Does anybody know how dollars are actually created by the Fed and put into the system?
On a keyboard.
Exactly. The relationship, and there's basically two ways that they can do that. Okay? This is Daddy Fed right here. Okay? One is the Treasury, right? One is the money center banks. Okay? And they do this through all kinds of vehicles. It used to be just a small number. They had things like the discount window. Okay, and that's that over here on this side, okay? The discount window. They had the treasury, they had the open market facility for moving treasuries. And now, and like I said, I'm going to get to some of these other, but these are called windows. They have these are, because going back to the old days when banks actually had teller windows, lending where you walked up to and talked to a teller, and that was the window that you got a farm loan from. This is the window you got a merchant loan from. They had all these windows. So they call them, euphemistically still, they call them windows. What happens today is the first way here is Treasury needs money because they're deficit spending. So the Treasury creates what's called a T-bill. Okay? And the difference between the two here is when you look at this way, this is almost always directly inflationary, going out this way. And I'll explain that a little more. And this is almost always indirectly inflationary. Okay? But what they're doing today is really confusing the landscape as to what is or is not direct or indirectly inflationary or deflationary. So the Treasury, under authorization of Congress, says we got a deficit spend, we need to pay our bills, we don't have any money, how do we get money? Well, we make up this thing on a keyboard called a T-bill, and we send that over to the Fed. One path, again, there's two paths out of the Treasury, okay? One of which is inflationary, one of which it's a net neutral, one of which is inflationary. The Treasury can also sell on the open market, okay, go in this direction. They can sell that T-bill go in this direction. However, lately, because the Fed, for its own purposes in creating all these new windows that it's shoving money out, it wants to buy lots of T-bills, because a T-bill to the Fed is an asset, okay, against which it sends Federal Reserve notes over to the Treasury that covers that T-bill, okay. Unfortunately, for us, the taxpayers, it doesn't, when it does that, it doesn't at the same time print the interest to go with it, okay. The interest, when the Treasury and the taxpayers have to pay back the money to the Fed, has to come with interest. Well, that has to be drawn off of the outside economy, obviously, and it's done in the form of taxes. Both the principal and the interest are paid back to the Treasury, which goes to extinguish the debt for the notes that they have. And that works just fine up until the fact that they mathematically make it impossible by printing so much of these T-bills and making the debt so large for even the 300 million people, if they're all put to work and paying taxes, to pay back the interest and the principal at the same time. So anyway, the Treasury, if it sells them on, so if you go this way, since you just created the T-bill out of thin air here, send it this way, they created the dollars out of thin air and sent them that direction, okay, the Treasury turns around and uses that to cover their deficit for the operating year, that's directly inflationary, because it's creating money that wasn't there simply to fund a need that probably wasn't there either, but Congress found a way to make it one. So, secondarily, the Treasury, on the other hand, can get money that's a net neutral by going to the open market. Why is it net neutral? Well, they turn around and they sell a T-bill to the public, right? For $100, you buy a bond. That money comes out of the economy. That's dollars coming out of the economy, going into the Treasury, right? Which they then turn around and spend after the government extracts their 40 or 50%. Then they put it back into the economy, and that's where, and then the T-bill has to be paid back to the holder, which is you, which eventually it comes back into the economy. The net basis of this is that it's basically a net neutral transaction when it comes to inflation or deflation, on a net basis. Now, it's hard to calculate all the differences in these things because simply the fact that how long it takes for, if it's a 30-year note, I mean, paid back over such a long period of time. And by keeping track of all of these accounts, that's how they come to the assumption of, over here, okay, what are we gonna set the interest rate at? What is our money worth?